What are the lowest down payment loans available to first-time homebuyers in the market today? You know, if you're thinking 20% down, or if you're thinking FHA, in both cases, those are just myths. In reality, there are lower down payment loans available through Fannie Mae and Freddie Mac, conventional loans with down payments as low as 3% down. And hey, those can be combined with down payment assistance to get them even lower, but this video is about low down payment loans. We're going to talk about conventional loans, FHA, VA, and USDA, all for first-time homebuyers. Hey, I'm Peter Lindquist. I've been a mortgage lender in Minnesota for over 30 years, and I want to share that experience with you in today's video. We're going to talk about everything you need to know about low down payment loans for first-time homebuyers. We'll talk about which is better for you, which is easier to get your offer accepted, which is least expensive overall. Stick around and we'll get through all of that data together. Hey, if you like today's video, be sure to give it a thumbs up. You know, that means an awful lot to me. It only takes you about a second. And also, if you're looking to buy a home, subscribe to the channel. We talk a lot about first-time homebuyer information that you're going to need along the way. And you know what? If you've got questions or comments, please leave them in the comments below. Let's start with the most common type of first-time homebuyer financing, which is conventional financing. Conventional financing is available through Fannie Mae and Freddie Mac, sold through lenders like us. They've got 4 different 3% down programs. Let's start with the first 2 of them. There's Fannie Mae HomeReady and Freddie Mac Home Possible. Now, these programs really share common characteristics. Both of them have maximum income guidelines, and this depends on the exact market where you're living in. For the Twin Cities area, the maximum income in order to qualify for this program is $131,700, but you get additional help on your mortgage insurance rate if your income is even lower, like beneath $105,000.
Just my luck.
Now, if your income is higher than that, don't click away. We're going to talk about programs that have no maximum income limits that are designed for first-time homebuyers.
Okay, I'm listening.
But also on these programs, the way that they calculate your income, I'm going to suggest you talk to your mortgage lender. Don't try to calculate this on your own because we use qualifying income to determine what your income level is. Let me give you an exaggerated example. Let's say that there's 2 people on the loan. One of you earns $130,000, the other one earns $500,000. You know, if you qualify on just the person with $130,000 of income, then you would qualify for this program, HomeReady or Home Possible. They both treat it the same way. There are several big benefits to HomeReady and Home Possible. Lower interest rates, typically lower by 1/8 or 1/4%. And there's no interest rate adjuster for what your credit score is. That's a huge thing because under normal conventional financing, the difference between a credit score of 719 and 720 is huge. Can literally cost you thousands of dollars. With HomeReady and Home Possible, we don't have to worry about that. And one big thing about conventional financing versus government insured financing like FHA is that sellers tend to prefer it over FHA. Sellers recognize that FHA tends to be pickier in terms of the quality of the home. The appraiser can call out repairs that the seller has to do prior to closing. Well, sellers don't want to have to do that. So if a seller has multiple offers, 5 of them are conventional and 2 are FHA, they typically will look past the FHA ones and favor the conventional financing. They feel that it's a stronger offer. It's harder for a buyer to qualify. So it's possible you might not qualify, but we want to do everything that we can in order to get you qualified. And on that topic, I'm going to mention that there's 2 things that can help you qualify on this type of financing. The first one is be sure that you are working with a lender who offers both HomeReady and Home Possible. I'm not really talking about the guidelines because the guidelines are similar between the 2, but Freddie Mac and Fannie Mae each have their own approval software that all secondary mortgage market lenders have to use. And there can be a significant difference, not only in terms of how much you can qualify for in terms of a purchase price, but also if you qualify at all. I just closed on a loan today that the buyer did not qualify through Fannie Mae, but they qualified through Freddie Mac? What if they were dealing with a lender who only offered Fannie Mae financing? They would walk away with a loan denial. So as you are shopping for lenders, that's really one of the key questions. Do you offer financing from both Fannie Mae and Freddie Mac? Now, as a first-time homebuyer, these programs do require that you get some homebuyer education. Basically, in order for them to give you the benefits, they want to make sure that you have taken an extra step in preparation for home ownership. Then the second tip I've got for you on this is that these programs will favor loans in which there are two buyers on the loan as opposed to one. And that's because there's lower risk for them. And understand this is that if there's two buyers on a loan, even if one of them isn't contributing income, there are two people who are going to try to make sure that that mortgage payment is being paid. If you are an individual home buyer and you're finding trouble getting that loan approval, try adding a second borrower. It can be a cosigner for that matter. And sometimes even if that second party doesn't have great credit, we have seen situations in which a borrower gets approved simply because there's a second borrower on the loan, even though the second borrower's credit is less than perfect. Now, those last 2 points are true of all conventional financing, but now what if your income is just higher than those maximum income limits? What do you do then? Fannie and Freddie have financing available for you. Yay! So they've got 3% down conventional loans that have no maximum income limits. You can earn as much as you want and qualify for this 3% down financing. You do have to be a first-time homebuyer. Their definition of first-time homebuyer, by the way, is that you have not owned and occupied a home within the last 3 years. If you owned a property a while ago and sold it 4 years ago, you're a first-time homebuyer again as far as these programs are concerned. The difference with this program really is down payment. You don't get the interest rate benefit of the HomeReady programs, and the mortgage insurance rate is typical kind of mortgage insurance rates. But the biggest benefit is that it's 3% down instead of the otherwise typical 5% down. You know, think of it, on a $500,000 purchase, the difference between 3% down and 5% down is $10,000 as down payment. So if that's what's holding you back from being able to buy a home is saving enough money for down payment, these programs may be something that you want to understand and see if you can get approved for them. Now, conventional financing is more difficult to get qualified for, and there are times when no matter what we try, we can't get an approval for you under conventional financing. That's what FHA is for. So FHA is a low down payment program. It's 3.5% down. It's not specifically for first-time homebuyers. There's no first-time homebuyer requirement, but they will work with credit scores under 600, for example. Their software is more likely to give a loan approval than conventional financing. And there are some big benefits to FHA. For example, interest rates typically are lower, sometimes 1/4 or 3/8% lower than conventional financing. So why doesn't everybody get FHA financing? And the answers are two things. One is that it's harder to get your offer accepted. Secondly is it's more expensive overall. That's because of the mortgage insurance premium with FHA. So on conventional financing, typically you're paying a monthly fee for mortgage insurance, where FHA, you're paying mortgage insurance in two ways. You pay it monthly, but then also with a single lump sum that goes on top of the loan. And that lump sum is 1.75% of the loan amount. That's actually a pretty significant number on a $400,000 purchase. That's $7,000. Now, that doesn't mean you're paying that out of pocket today. So you don't actually feel it immediately. You feel it when you go to sell the house or refinance it because you have added that money to your overall loan amount. That's what makes it more expensive than conventional financing. FHA financing can still work and overall is used by home buyers in today's market. With FHA, there's no maximum income limits. There's maximum mortgage limits that are a bit more restrictive than conventional financing, but still handle most of all what a first-time home buyer is looking for. Besides conventional and FHA, there's VA financing for our veterans. And veterans, if you're eligible for this financing, you really want to use it because it is the least expensive overall, gives you the lowest monthly payment, because there is no monthly mortgage insurance. There is a guarantee fee that is financed on top of the loan, but it's zero down payment and it's a lower interest rate than typical conventional financing. Generally speaking, if you're eligible for VA financing, that's the one you should take. Now, the last one is called USDA financing. That is not available in the Twin Cities metro. It's designed for smaller communities, generally with towns of 20,000 or less. That program does go as a zero down program, is also a government backed program, and it's a great option for homebuyers in smaller, more rural communities. The appraisal type is going to be very comparable to FHA, and so it's not a great home for fixer-uppers. But again, if it's the difference between you buying a home and not buying a home, we will definitely look at USDA financing in your pre-approval process. So what are the lowest down payment programs available today? Well, technically, VA and USDA are, but they're more limited in scope. So conventional financing is the lowest, generally speaking, at 3% down. It's much easier to get your offer accepted. It's harder to qualify for. But if you're going to your lender and they're only talking about FHA, I want to highly encourage you to also ask about conventional financing, especially as it regards HomeReady and Home Possible. Hey, thanks for being with me today. I'm curious, are you planning on buying a home in 2026? If you are, what area are you looking to buy in? Please leave that in the comments below. Hey, I'm Peter Lindquist. Thanks for taking the time to be with me today. Have a great day.
We will get you home.